Okay, so Sabina, thank you so much for taking the time to talk today about variable versus fixed. I know that I posted this literally on the Facebook page yesterday, and we've had 60 people register to find out, okay, variable versus fixed, what's the best decision to make right now? And so I wanted to get you and Dustin to get your opinion on what you're telling people. So when I look in the news, I'm seeing some news is saying rates are going to go up right away. Some news is saying the opposite. So what's your sort of take on what's going on?
Well, in terms of whether rates are going to go up, I think that we've got a very volatile year ahead of us. With oil prices being down, the Canadian government there still has to be some consumer confidence going on, and with the energy markets being weak right now, we also look at other markets like banking sector, insurance sector, that kind of thing. And if there's a rise in interest rates, that's going to affect the bank rate margins, which are going to be tightened, and we don't want to have issues in both markets, in both the banking and the energy market. So I think that if there is going to be a rise in interest rates, it's not going to come until later into the year, and I think it's going to be a slow process. I don't think we're going to see any big jumps. I've heard, was it Benjamin Tall said last year, he was saying that we've been in this environment of low rates for so long that we've created a new sense of normal. We have to be careful when we're raising interest rates and look at the impact on it. I think the threat of interest rates is actually going to create a bit of a boom here, because I haven't talked to any broker that hasn't been busy the last 8 weeks. It's been absolutely insane. So I think it will be an increase of rates of sorts, but it's gonna take a little while before it comes in.
Right, and so when a customer comes and talks to you and says, "Okay, Sabina, I'll give you an example," because I find for me, obviously the right answer is different for every client. Like, it's not like you can say everybody should go fixed, everybody should go variable. I don't think then we're not really doing our job. But so let's say I have a customer I'm trying to think of somebody I worked with recently. So he's a merged doc, putting 20% down, excellent credit. His GDS is probably in the 20% range. So you have a client like that, and they say to you, "Sabina, what should I do? Should I go variable fixed? The bank's telling me to go 5-year fixed." What do you usually say to somebody like that?
Well, it's not just the profile of the client; it's also what the client goals are and that kind of thing. So I will interview the client and find out more about what their long-term goals are. Are they trying to prepay? Are they trying to maximize? Are there any taxable benefits of them actually keeping the interest rate higher? That kind of thing. So. But for the most part, with that kind of profile of client, I'd probably be edging towards the variable rate. They can handle the peaks and valleys of it, and they're probably going to pay a lot less interest over the long term if they're going to go variable. But like you said, I mean, when you've got clients that are there's no blanket answer for variable versus fixed. It's always situational. So if you've got a first-time buyer that's really stretching to buy their first home, that's not the kind of client that I'm going to put into a variable rate mortgage. I'll discuss it with them and talk about the strategy and say, when we get to that next stage, when your 5 years is up, we can look at doing that based on where your income is at. But going into it, definitely variable for those clients that have room in their income and the room to budget to prepay.
Mm-hmm. And it seems to me that when it comes with the variable rate, we'll stick to that for a second. So the variable rate, there's two risks. The one risk is, when do I lock in? And then the second risk is, what rate am I going to get when I lock in? And so how do you address that with your clients if somebody is in a variable? Do you have sort of like some kind of an answer that you give them?
Yes, I go back to my Greg Williamson training from 3 or 4 years ago, where we discussed the inflation hedge strategy, and that strategy was a big reason for my success in 2009. I had a great year that year, and basically, why would you lock in your mortgage at, say, 3.5%? Your payment's going to go up. Why don't you just increase your payment as if you had locked in and have that extra money go towards your balance? You're actually creating a better insulation by paying down your balance faster with that extra lump of payment every month than if you were to lock in at that fixed rate and you're still facing payment shock in 5 years when that mortgage comes up for renewal. Because if you lock in today at, say, 2.99, you decide to lock in, and rates in 5 years are, say, 4%. You're going to have that 1% of payment shock there. Right. But if you were to increase your payments accordingly as if you had locked in, you're paying down your balance and almost saving yourself from that inflationary interest rate of sorts by paying down your balance and creating a lower net payment.
Mm-hmm. And so, how do you manage that for clients post funding? So, we had a discussion. Okay, we should be making those adjustments. Are you on some kind of program to do that? Or are you doing that manually, or?
Well, I have a CRM that where I have my variable rate clients differentiated separately from my fixed rate clients. So I do communicate with them when Bank of Canada meets and let them know what changes have happened, and if they should lock in, that if they're thinking about locking in or want to make changes, that they should contact me directly. And then I actually, it's a great opportunity to connect verbally with my client and then go through their specific situation and make recommendations on how much they should increase their payments by instead of locking in.
Right. Okay, that's good. And so, yeah, I have found that there's definitely a lot of my clients are contacting me and saying I'm a bit stressed about what's going to happen. And
yes.
So when you got somebody, let's say in a fixed rate, and they're a couple of years away, what are you saying to somebody who's in a fixed rate and they're like, hey, what should I be doing? What's your advice for that type of client?
Just to pay as much extra as they have against the balance now, so that when their balance comes up for renewal, that they're not faced. Like, if they reduce their balance now while the interest rate is low, if the interest rate is higher in 5 years, they won't have as much payment shock if they get that balance down sooner.
Mm-hmm. Right. Okay. So give me 1 second. I think I might be able to get Dustin on here. Maybe. So is there any other research, or you said that you had some stuff that you wanted to share? So do you have any other research or some data that you typically find that's helpful for when speaking with a client about the discussion between fixed and variable that you've been sharing?
I do. I pull from various articles that I see come up, like when there's stuff coming up on Canadian mortgage trends and stuff like that, where there's kind of an impartial party talking about interest rates. I'll refer my clients to that, but I don't have. And there's also a tool within Verico where we have a fixed versus variable tool that shows that if the variable rate goes up by a quarter point or a half a point a year compared to your fixed rate mortgage, would you still save money over 5 years? Mm-hmm. So we can use that tool as well. And I find that when I'm talking about a variable rate to my client, I always do recommend that they pay as if they were fixed.
Right.
And whether they do or not is up to them, but I've made that recommendation so that in fact that if they do that, they will pay it off faster. And I use my own self as an example, paying as if I'm at a 3% rate instead of on the variable and that kind of thing.
Right, so that when you do have to lock in, you'll owe less. So then you end up with you're still in a good position.
Payment. Yeah. And again, when you're telling your clients to lock in, it's situational. If you have a client that can ride the wave, why wouldn't they? Because if it's how much is it going to go up, and how quickly is it going to go up? How much? There's Dustin.
Hey, are you there now, Dustin?
Yeah, I can hear you. Can you hear me?
Yeah.
Yes.
Can you turn up your mic a little bit?
Hang on.
Hey, you got a beard, a playoff beard.
Indeed, I do.
I find I look down on this because I'm trying to see you, but my camera's up, so it's like I'm staring at my laptop. So hey guys, we've got Dustin on the line, and we have his ceiling as well.
There we go. We got audio now?
Yeah.
We've got audio, we have visual. This is outstanding. So I'll switch to Dustin now. Dustin, I just want to ask you, obviously, I'd said, I don't know if you heard it, you were trying to get online, but the discussion of variable versus fixed seems like a lot of brokers are trying to just, having those discussions with their clients. And so I wanted to hear what you're saying and what you're communicating to your clients around that discussion.
Well, for brand new clients and for existing clients in variable rate, the number one thing I always return to. Sorry, we're still there?
Yeah.
Number one thing I always return to with them is, that 6 out of 10 Canadians statistically break their 5-year fixed at an average of 38 months. And when they break that mortgage, they're triggering a prepayment penalty, the IRD, typically, if they're with big bank or credit union. And that prepayment penalty can be 3.5% to 4% of the balance, whereas a variable rate mortgage penalty is typically 0.6% right now. So I always like to make sure they're aware of the potential penalty exposure that exists within a fixed rate mortgage, weigh that. That's I think a very important factor. And especially like the news. I mean, I've had a number of calls and emails in the past few days myself saying, hey, the news is saying rates are going up. I'm like, well, okay, this morning we all got an email from Scotiabank saying actually rates are gone down 0.05% on the 5-year. The lenders, the people who are actually lending the money, are actually lowering their rates, but the media has people in this sudden panic that rates are about to start going up. And one of the stories a client emailed me, I pulled it up and read through it with them, and I'm like, do you see the part here where it says Bank of Canada may raise prime by 1/4 of a point in the fall? And he says, yeah. I said, okay, your mortgage is a $300,000 mortgage. 1/4 point on $300,000 is a $37 a month difference to your payment. Does that have you losing sleep? No, of course not. But there are a lot of people right now, I think, losing sleep over where rates are going unnecessarily.
Right. Yeah. No, that's good advice. And so what I've noticed too is that the bond market's getting beat up, even in the U.S. Like I was watching the bond market rates or bond prices, and it's just going down. And so you've got the media. CBC News came out with this article that seems to be the one that's driving it. And then they're saying, oh, rates are going up, and then I'm looking at the bond market, and I'm looking at, there's uncertainty over oil, and are they going to be raising rates if the economy is not, be growing as fast? Because we're definitely tied a lot to oil. So what is your take on, like with the U.S., obviously we're really tied to them. So if you see anything changed in the U.S. coming that are going to affect us, like if they raise the rates, are we going to be delayed by a lot, or is it going to be a short delay?
My opinion, for what it's worth, I believe just yesterday the U.S. Fed said they're not going to be doing anything with rates until April at the earliest. And I mean, this is the story we've been hearing out of the U.S. and our own government for years now. We're going to move rates soon, and soon never comes. So, will the Fed actually raise rates come April? Maybe. Are they going to move them a whole bunch real fast? Not likely. Mm-hmm. And even when they move rates, is Canada going to follow suit? Historically, we have. And I don't ever like to fight history. I mean, I always say for arguably 40 years, the variable has been the winner. So I'm not smart enough to say today is the U-turn on that. I'd say the same thing with rates, as far as the U.S. and Canada goes. If the U.S. starts to rise, well, you know what? If they raise rates, probably Canada will follow. Will we follow immediately and in lockstep? Maybe not. Maybe we will lag behind. So if the U.S. bumps rates in April or May by 1/4 point, maybe that leads to a 1/4 point hike in Canada in August or September. That would be my prediction on that topic.
So, Sabina, anything else you want to add to that? And I'm going to open up to questions if anybody has questions they want to throw out for you guys.
Just that Bank of Canada hasn't said anything about them raising interest rates. It's all speculation at this point.
Mm-hmm.
So, Bank of Canada usually when we were seeing when we saw prime hit its lowest, and then when they started bringing it back to the 3, they were giving us warnings well in advance. And I think what's going to be important is what happens at the next few meetings, what their indicators are in the next few times that they meet, and what the language is when they set the rate. If they don't change it next time, what's their language when they're talking about that rate? Because I have a feeling that they'll give us some ample warning before they start increasing that rate.
Right. And so have either of you been doing any reading on the impact of oil? Because I've kind of heard two different things. I want to hear from you guys. The impact of low oil prices either causing inflation or disinflation, because I've read both. So you guys have a take on that?
Go ahead.
Well, just that if energy markets are down, that the banks are also going to be, as I said before, the banks would be affected if they started increasing rates and their profit margins started to get crunched. That it may not be in the favor of the banks to start increasing rates in that sense. So it wouldn't create effective increasing interest rates. Right.
What about you, Dustin?
Yeah, no, I agree. I think low oil prices typically would lead to low rates because you're conceivably going to wind up with lower employment in the oil patch, and lower employment isn't going to get the numbers where the Bank of Canada wants them to be pushing rates up.
Right. Sounds like one of you guys is near a port or something.
Yeah, it's not me, I don't think.
Is there a ship or something going in the background? Like,
No.
I can
Oh
hear
wait,
something.
I am on the beach, but you can't hear the boats from here.
I hear like this horn from a ship. I'm like, what is going on with this thing? So, yeah, well, I really appreciate your guys' time on this. If anybody has any questions that they want to ask, I have found that for me, this discussion of variable versus fixed comes up more, and it's good to get other people's perspective on how they're answering these questions, right? So do you have any other strategies that you sort of implement in there when you're talking to them about a fixed rate or a variable rate that helps you sort of communicate with the client? You can go first, Sabina.
Well, Dustin missed a lot of playtime here, so I feel like he should catch up and maybe get some more airtime here.
Okay, I'll go to Dustin. So Dustin, do you have any strategies you find helpful when you're communicating rate decisions to clients?
As I say, thanks, Sabina. Yeah, as I say, I do focus on prepayment penalties, and I don't think that my clients have necessarily heard me the first time. So maybe when we set the mortgage up, that's a decision that drives them towards variable. In my own book of business, about 85 to 90% of my clients go variable. So I got a whole lot of people that are going to be, worked up when rates do start moving. But as I say, I circle back onto that penalty conversation a lot of the time, especially if it's 3-4 years in. Do you see yourself in that property for another 5 years? Is there a potential change that may cause you to break that mortgage? Hard to predict at that point, or maybe it's easier to predict, I should say. So that's always a topic, but every New Year's, I send an email out to all my clients, as I did just recently, encouraging them to bump their payments up by $50, $100, and if they keep doing that year after year, they're, as Sabina touched on earlier, they're building in that padding, where not only is that extra money more quickly bringing the balance down, but in addition to that, they've also got
Where did you go? Technology is wonderful when it works. Hey, Sabina.
Yes.
You know what? This is the best. Dustin is probably like some secret recipe you're sharing. We can't hear you. Are you still there?
He's gonna start throwing the headphones at the screen any minute now.
Well,
Can't hear you.
Okay, I'm gonna do. I got a poll that I'm gonna.
It's a good thing I let him go first, right?
Yeah.
At least we got a little snippet of that.
So
great.
So what was the last thing you just said?
Where did you lose me?
I can only tell you what your facial expression was.
Yeah, I got lost by the. So just wind up.
When you were talking about the New Year's email about bumping their payments and padding their balance down.
That's right. Sorry. So exactly as Sabina was suggesting earlier, building in that buffer against rising rates and also paying the balance down faster. And the number one thing that I set clients up with from the start is, let's make your payments based on a 5-year fixed, but let's take the variable rate. And then they're truly getting the advantage of a variable rate mortgage, in my opinion.
Right. Anything else you want to add, Sabina? And I got a comment from the chat room that I'll mention. Yeah,
I see that comment actually, and I'd like to address that comment about the IRDs in a rising rate environment. I'm finding that with the banks, I've had situations where I've had clients in a higher rate, or pardon me, in a higher rate, lower rate going to a higher rate and still paying a significant IRD. So they're going to be paying a higher interest rate, same institution, still paying 4% of the balance. So I don't think that IRD is on the basis of there being, that the client is breaking the mortgage and getting a lower rate mortgage. They may be getting a higher rate fixed mortgage at that point, and they still are faced with that IRD. I've seen that in the chartered banks, at least, not with the monoline lenders.
Right. Yeah. Have you seen that, Dustin?
Yeah, absolutely. I mean, what a lot of people fail to understand is that IRDs are based on the shorter term remaining. You know, so if you've got 3 years of the way into a 5-year, your IRD is being based on the 2-year with the discount applied to it. So
Right.
even if 5-year rates start to rise, that doesn't necessarily mean that 2-year rates or 1-year or 3-year rates will rise, because those are tend to be predicated on Bank of Canada Prime.
Mm-hmm. Right, that's true.
And the discount between the posted rate and the discounted rate, like say you've got like Scotia today dropped from 299 to 294, but the posted rate hasn't changed. All that's changed is that discount, which increases their IRD.
Mm-hmm. Oh, I once had a Scotia client who, and I shouldn't say their name, but it's fine. So I had a Scotia client. They had a mortgage that was from last year. It was 2.89%. It was right around 300 grand, and they wanted to break it. And at the time, Scotia's rates were 309 on a 5-year fix, and their penalty was still something like $12,000. And my client was like, "How can this be, right? Like they were actually breaking it. They were 1 year in, and their new 5-year rate would have been higher, but I don't find that as much either with the credit unions or with the monolines. They seem to be a lot more fair on their penalty calculation."
Yeah. Yeah, if I'm going fixed with if I have a client that absolutely insists on going fixed, I won't place it with the Scotia. I'd rather go with a variable. With the chartered banks, I would rather do a fix with the monoline lenders just in case. Because as I said in my post yesterday, something that people aren't prepared for, that 6 out of 10 people that think, oh, I'm going to be there for 5 years, but then there's things like, I showed up, when my one client showed up one day and her husband had left a note on the door telling her that he was leaving her, and that was the end. And she had to sell the property because she couldn't afford it on her own.
Mm-hmm.
So, and that wasn't something that she was prepared for, and that wasn't something that the mortgage, that we had structured the mortgage accordingly. And at that point, they'd been married for 15 years. So not expecting that, but things happen, lives change, and we have to, since we see that more and more, we have to anticipate some of those changes and prepare our clients for that.
Mm-hmm. Any last words, Dustin, before you have to go back to work?
Yeah, no, on that topic, I agree completely. I mean, life is very unpredictable, and I usually take my clients through a short arc where I talk about 2 young single 20-somethings or 30-somethings who each buy a studio or each buy a 1-bedroom. They take a 5-year fix because mom and dad said that was smart. They buy in a rental restricted building because mom and dad said that was smart. Then they meet each other, fall in love, and now they got one too many studios and they can't rent one, so they got to sell it. So there's the first penalty. And then they wind up pregnant and the studio's too small, but it's okay. They're going to be able to buy a bigger house because they got a great job in the oil patch. So he's moving from BC to Alberta, but they took that other mortgage with a credit union, so they can't port that to the other province. A lot of people are unaware of that. So boom, there's another penalty. Mm-hmm. And you can take them all the way through about 8 to 10 different penalty scenarios that for the most part are good news stories. And then of course there's all the bad news stories, and this tends to be the time that a lot of those bad news stories come out every year. People make it through the holidays, and then January, February, you do get a lot of splits. And again, a lot of people, like Sabina said, they can't afford to carry that property on their own, and they're back into a penalty. And to your earlier comment, Scott, I too had a clients just recently with that same lender, and $400,000. Yeah, exactly. $400,000 mortgage, 6 months in, 299 5-year fixed. Rates hadn't changed. $18,000 penalty, 4.5% of the balance. And I made it crystal clear to them that they should A, go variable, and B, do not take a 5-year fix with a chartered bank. Here's how the penalty works. I even send them a link to the bank's penalty calculator and to a monoline's penalty calculator, and I explained to them, like, play with it, look at the difference. And so, at least I'd done my work. So in that case, I wound up assisting both of those clients with their new purchases, because neither of them was upset with me, because I'd explained it crystal clear. I'd all documented in emails. So they weren't happy with that penalty, but they weren't holding it against me either. So, that's where the education of your clients really pays off in the long run.
Right, that's killer advice. So that's anybody listening, take notes on that. That was awesome. That whole spiel. Good thing we got this recorded, although there's a bit of mess ups in the beginning. Sabina, anything you want to say before we're done?
No, thanks for having me on.
Okay, well, thank you guys for coming. Thank you, everybody who attended. I think we had like 48 people on the call, which is crazy. And there'll be a recording sent out so you can go back and something if you want to catch those parts where it was all messed up, you can do that. So, okay, see you guys.
See you.
Take care.
Bye.
Thank you.